Okay, it's Friday after the close, and let's just say it's been a ride. This was one of the most emotional weeks investors have had to navigate in a long time. A heavy news cycle, major price swings, and probably the most important earnings week of the entire season. Roughly 30 to 40% of the S&P's market cap reported this week. We're going to cover it all. The big names, the moves out of Washington, and most importantly, the theme of the week. Nothing changes sentiment like price. Just a few weeks ago, markets were hanging near the lows. April was on track to be a disaster, maybe down 15% on the month. But somehow, some way, we clawed back to nearly flat by month's end. That didn't happen by accident. Remember last week, Goose Hollow's Krishna Kumar? He said it best. When you're searching for reasons not to own something, maybe stop and ask, what could go right from here? And that mindset paid off. There are cracks beneath the surface. And when it comes to trade policy, who delivers the message seems to matter just as much as the message itself. These adjustments aren't just coincidental. They're timed, they're targeted, and they're aimed at soothing investors. Late Thursday night, some softening in the rhetoric coming out of China pushed futures higher. And that's on the heels of the largest company on the planet, Apple, disappointing investors once again with another ho-hum quarter and little evidence they are any closer to getting their arms around how to best monetize AI. We're going to dive into all of it. What did we learn from Apple? Did Microsoft just reset the tone for this entire market? I'll tell you why that earnings report might be the most important of the quarter and why the timing of it raised more than just a few eyebrows. Speaking of timing, let me show you something. Wednesday morning, we get a GDP print, comes in soft. Futures drop about 1% right out of the gate. And then, who do I see on my screen? Peter Navarro, standing on the White House lawn. The Darth Vader of trade policy. The more he talked, the more the market sank. Down nearly 2% by the time he wrapped. Then, just before the close, boom! A massive spike in futures. Minutes later, Microsoft drops a blockbuster quarter. Coincidence? Yeah, maybe. But I've seen enough of these to say it doesn't pass the smell test. Then again, just before Thursday's close, another sudden drop. What follows? Amazon missed, Apple disappointed, two pillars of the Magnificent Seven, and again, you get a last-minute swoon in stocks going into the close. It couldn't feel more suspicious. I can't know for sure, but leaks like this, when they happen, are criminal and force investors to lose faith in the system. And finally, Friday. Better than expected jobs report, a monster move in the market, completing a full round trip back above the April 2nd Liberation Day close. So much to unpack, so much to question. This is the Money Runner. I'm David Nelson. I said it at the start. Nothing changes sentiment like price. And at least for the moment, the rhetoric has shifted from this could get a lot worse to we may have seen the market lows for this cycle. And if history's any guide, we will be tested for the next few months. Remember, we're only one tweet away from the Dow being down 1,000 points as President Trump and Xi haven't even begun negotiations on how to reset trade relations between the two largest economies on the planet. How we respond as both investors and Americans will say a lot about how this plays out. As I pointed out on Bloomberg BNN this week, Americans may not have the patience for a full reset in trade. I think it's a given everyone wants fair trade. Right up to the point when it hits their personal bottom line. And look, I put myself in that camp as well. Markets go down, you can bet it hits my bottom line. That's the challenge President Trump and his administration are up against. How do you reset an 80-year-old trade doctrine that many believe has put the U.S. at a disadvantage and at the same time keep the U.S. from slipping into recession? That conundrum plays out in real time in the markets each and every day. All right, I said I was going to talk about the biggest themes driving the news cycle this week. Here we go. Microsoft just delivered one of the most important earnings reports of the season. Not just because they beat expectations, but because it may have confirmed something far bigger for the market. AI isn't just a story anymore. It's revenue, it's scale, and it's global. Azure grew 35% last quarter, and over a third of that growth came from AI workloads. Microsoft is building data centers so fast they're running out of power in some regions, and still they can't meet demand. That tells us two things. First, enterprise AI cycle is real and still in its early stages. And second, investors may finally have a clearer path forward. This wasn't a quarter about layoffs, cost cuts, or rate fears. It was about growth, real growth. And for those wondering if the worst is behind us, this quarter offered a powerful signal. The AI CapEx cycle is accelerating, and Microsoft just told the world they're all in. Let's turn to Meta. Zuckerberg and company posted another strong quarter with revenue up 16% to $42.3 billion. And ad pricing jumped 10%, a sign that AI is driving real performance gains. Their new ad ranking model is lifting conversions, and nearly 1 billion people are already using Meta AI. The standout, though, is CapEx. Meta raised its 2025 spend to as much as $72 billion, most of it going to AI infrastructure. That's a clear signal. The AI trade is alive and well. You don't commit that kind of capital unless you're confident it'll pay off. Are the risks? You bet. EU regulators could hit ad revenue in Europe, but for now, Meta is leaning in hard on scale, engagement, and long-term AI monetization. You can't have a conversation about the market without talking about the Fed. We still have an ongoing war between Trump and Fed Chair Powell. Trump wants lower rates, and Powell, he's stuck between a rock and a hard place. April's payroll report came in hotter than expected, 177,000 new jobs added versus 138,000 consensus. That's given the market a lot to chew on. And while wage growth cooled slightly, the overall strength in hiring has many analysts pushing out their expectations for the first Fed rate cut all the way to July. Bottom line, the labor market, for the moment, is buying the Fed time. And unless we see trade tensions escalate or a sharper economic slowdown, a June cut isn't going to happen. All right, we did it. Some good news to take us into the weekend. Don't forget to learn more about yours truly and the Money Runner. Go to my Substack site, dcnelson123 at substack.com. Subscribe for free. I'm David Nelson, and this is the Money Runner.